Good morning, everyone. This is Marshall Giller bringing you the morning comment for April 7th. Friday's weaker than expected non-farm payrolls don't seem to have changed attitudes at the Fed. New York Fed President William Dudley, a noted dove, Monday said he viewed the figures, quote, as reflecting temporary factors to a significant degree, unquote. Those factors being the unusually harsh winter weather. Atlanta Fed President Lockhart basically agreed with him and said, I'm not ready yet to conclude a slowdown is underway. Reflecting these statements, the Fed funds market and the U.S. bond market unwound a lot of Friday's move after the disappointing non-farm payrolls, and the dollar bounced back as well. The comment suggests to me that the Fed is still in line to tighten, and thus the dollar rally is still in line to continue. Among the G10, only the Canadian dollar managed to keep pace with the dollar's gains. That was surprising, since the Bank of Canada business survey was fairly weak and the IV PMI showed further deterioration. I can only assume that the Canadian dollar remains stable because of the rise in oil prices. Oil prices rose after Saudi Aramco raised its prices for crude shipped to Asia over the weekend. There was also news of either a small rise or even an outright decline in U.S. inventories. Either way, that's a far cry from the recent huge rises every week we've had week after week. Nonetheless, I think the figure for the inventories represents only a temporary factors, and I'd expect to see another large build in inventories in the following week with a corresponding decline in prices and in the Canadian dollar. Now, the Reserve Bank of Australia kept rates steady at its meeting Tuesday, in contrast to the market, and I have to admit, our expectations of a cut. They continued to complain about the strength of the Australian dollar and retained their raising bias. While the Aussie dollar gained on the news that rates were being held steady, I believe this rally may provide an opportunity for going short on the Australian dollar. Today's highlights: during the European day, we get the final service sector PMIs for March from the countries we got the manufacturing data for on Wednesday. Service sector PMIs may be revised up, which could support the euro somewhat. In the U.S., the Job Opening and Labor Turnover Survey, the JOLTS report for February, is forecast to show that the number of job openings has increased marginally. The market will also be watching for the quit rate, an indication of confidence in the job market. As for speakers, Minneapolis Fed President Kocherlakota speaks. Kocherlakota is a major dove, and it will be interesting to see what he says following the weak labor report on Friday. He spoke briefly on Friday, but didn't mention the economy. Now, the Bank of Japan started its two-day policy board meeting today and will finish tomorrow overnight before I get to make my comments. The market expectations are for no change in policy at this meeting. Inflation is trending downward, but the bank already admitted at its last meeting that it's likely to hit zero. FX market participants are waiting for the April 30th meeting, when the bank will release its semi-annual outlook for economic activity and prices. If the inflation forecast is revised sharply downwards then, or fears are expected about overseas economies, Governor Kuroda could propose further easing measures then. For more information, including technical analysis, please read the full comment on IronFX.com. You can also follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google+ to get more trading ideas. This is Marshall Giller, head of Global FX Strategy at IronFX Global, wishing you solid trading.